QuickBooks Pro Desktop 2021 Receive Payment Form. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars practice file. We currently have the home page open. You can open the home page by going to the company dropdown, selecting home page. We also have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're going to go ahead and collapse the open windows so we have more space for our home page. In the past, we've been taking a look at the customer section, the customer flow, remembering how we want to do our data input or think about this process. If we have something to input, we want to think about, does it fit into one of these normal flows, such as this flow here, which is the customer flow, the accounts receivable flow, or the sales flow, the revenue flow, the AR accounts receivable flow, all same kind of concepts for the same types of transactions, the customer transactions. So does it fit within the transaction? Then you want to memorize or think about, be able to picture what the flow will do and get a feel for what's going to happen on the accounts side of things as you do so. And then you want to be thinking about what's the actual form I need to be using within the flow. Then you want to think about when I use that, in this case, we're going to be using the receive payment form. And then you want to think, okay, what's going to be the impact of that form on the financial statements being the reports of the balance sheet and the income statement, or P&L, and then the effect that might be on some subsidiary statements or subsidiary ledgers, such as the receive payment having an impact on the accounts receivable subsidiary ledger, breaking out that information by customer. So remember, in the past, we have the invoice, so we're on the invoiced track here. There's two types of sales that could be made. Either we make it with an invoice or create sales receipt. The invoice is going to be the type of company if we're receiving payment for work that had been done before if we're doing work before we have received payment. And that would be something like a law firm or a CPA firm or something like that would be types of examples of that, where we have to bill the client, do the work, and then typically bill the client. Then we're going to receive the payment at some point in the future. As opposed to if you imagine a situation where someone brings something up to the cash register, like in a restaurant or in our store, in our case with a guitar, and they just bring the thing up to the register, you're getting paid at the same point in time the work was done, and therefore you would record it with a sales receipt. So we're thinking about this flow over here where we do the work, bill the client before we get paid, which would usually be driven on the type of industry. This would typically be increasing the accounts receivable, this form of the invoice, increasing the accounts receivable, representing people owing us money, customers owing us money. The other side going to sales. And then there could be something with inventory and cost of goods sold and sales tax if it's an inventory item, but we're concerned here with the receivable because we want to get paid on that. And then we expect to receive some payment in the future. Now, the easiest way to kind of visualize this is the invoice being mailed out, although now it's going to be emailed out oftentimes. And then the receive payment, meaning we get a check in the mail, although we may get paid in some other format these days, like an e-check or credit card or some other type of format. But that's how you'd want to visualize these items. Now, when you hit the receive payment, even though we are getting cash, we're not recording revenue at this point in time. What's going to be the impact of the receive payment form? Because it's a receive payment, that means it's going to be decreasing the accounts receivable. It's going to be decreasing the account that represents people owing us money. We're not going to hit sales with it. We're not going to hit revenue. It's not going to affect the income statement because we hit revenue when we made the invoice. The invoice being closer to the point in time we earned the revenue, closer to the point in time we did the work. So now we're just going to be decreasing the receivable with the receive payment, and the other side is going to some kind of cash account. Now, this is going to be the place where it's most confusing. This is often a place where errors are made with the bookkeeping process because the default cash account here is not the checking account. It's going to be the undeposited funds account. Also note that if you have a background in accounting, then you've learned when you do journal entries that you're going to debit, in this case, you would debit cash, meaning cash would be increased. In other words, obviously cash would increase because we're going to be receiving a payment. But when you learn financial accounting, we don't break out the cash into the different formats of cash. Here we do have to do that because we have the checking account cash, and we might have some other kind of cash that means we're holding on to the check and or we're holding on to cash. So we need to be able to make sure that we're taking care of the checking account properly so that we can do the bank reconciliation properly at the end of the month. And so we have this added step that you might not really see if you've worked in learning financial accounting, where you would just basically increase the cash account. So the default here will be to increase undeposited funds so that we can then group our deposits in such a way that they will be matching on our books to the bank statement as they will be seen in the bank statement. That's going to be the default setting. Now, you might not always need that. It depends on how your deposits will look. For example, if you get different checks and you just get individual checks, and let's say you scan the checks with your phone or something like that, and then they go to the bank, they're going to show up on your bank statement as individual checks, as individual deposits, and therefore you don't really need this added step because they're going to be grouped in there as individual payments. When you see them on the bank statement, they will be grouped as individual payments. When you reconcile to your books, they will be on the same format, no problem. However, what if you were to receive something like cash payments and you receive multiple payments during the day? Well, then you would have to group them together and go to the bank at the end of the day. When you deposit them into the bank, they're going to be grouped in as one lump sum. So you're not going to, if you record it on the cash receipts as all individual items to the bank account, then it's not going to match. The bank statement's not going to match what you have in your books, and you're going to have to do some finagle, and you're going to have to kind of add up things and whatnot to do the bank reconciliation, a huge and important internal control at the end of the month. You want to make that process as easy as possible, and therefore you'd put it into undeposited funds and then group them in the same format as they will be seen on the bank statement in your books by then recording the deposit, grouping them together. This little 2 will help to indicate that you have items in undeposited funds that were created either through the receive payment or the create sales receipt items here. Now, you could also have the credit card companies, the other kind of thing that really messes things up. So the credit cards, if you receive credit card payments, you have a third-party credit card company that might be grouping the credit card payments in some way, shape, or form that you need to know so that you can match that basically on your side so that when you do the bank reconciliation, again, it'll be as easy as possible. So if you're working with credit card statements and they're grouping your customer deposits together, you got to work with the credit card statement and your bank and your QuickBooks system to try to line those things up so that you can group your deposits in the same format as the credit card company is grouping them as they deposit them to the bank, so that when you do the bank reconciliation, it'll be as easy a process as possible. So let's go into the sales receipt here and just check it out. I'm going to go to the prior one so we can see one that's been done. Now notice when we looked at the prior screen, it said sales receipt. And when you go in here, it says customer payment. So the fact that there's a different name can be a little bit confusing. So it could be called sales receipt. It could be called a customer payment. When you see it on the general ledger, when we go into the detail, it'll be just called payment. So they're all basically the same form, the data input form. So you got to kind of keep that in mind. Also note that this is often thought of like an internal type of form. It's a form, but it's not like the invoice that we're going to give to the customer or sales receipt that we often give to the customer. However, you might give this to the customer as like a thank you letter or something like that. And I believe you can, it's a fairly new update, customize this form so you can make like a thank you letter or something like that for the received payments. So we're not going to get into the customization of the forms here. We might have another section after the practice problem, just talking about that kind of thing, like the customizing of the forms to make them look nice or possibly gear them towards different uses or different companies. Here we'll get into the kind of the functionality of it. So when you have the customer payment, you're going to imagine you're receiving a payment. Either you got a check in the mail or you got some other form of payments. You're going to enter this into the system. You're going to need the customer to do so. When you pull up the customer here, and you shouldn't have to add the customer unless it's a deposit or something before you did the invoice. We'll talk more about that later, but because you would have had to make an invoice before you got the payment, typically. So then you'd have the customer would always be there. Now, when you open up the customer, then you'll have the received payment will have the invoices that are related to that customer. And if you double click on the invoice, it'll actually go to that invoice. Once you record the received payment, that invoice will show as paid with this little icon. Closing this back out. So then if you were to check off the invoice, then that would actually default to the payment amount that is still due here. Now, if you're only getting partial payment on it, then you can have a payment that will be less than the amount due. Down here, we have the original amount of the invoice, $1,500. The amount due, $1,350, because there was already a payment on it. This is going to be the payment that we have up here, and so there would be no amount due after this point in time. And then we have the types of payment: cash, check, credit, e-check. These are basically for informational type of purposes. They're not going to be changing the invoice or the actual form or the effect on the financial statements, but they might be useful for your internal purposes. So when you go back to the information, you have as much information as possible on that payment. For example, if you go to cash, you might want something in the reference number or memos about the cash because there's less of an audit trail. If you go to check, it just changes this to a check number. So we could put the check number. It's not our check number. It's the check number of the check we are receiving from the customer just as a reference. Credit card information, we have the credit card information, and then e-check will change that once again to the reference over here. So then we have the confusing component here, which is the undeposited funds. This little drop down may not be there on your form. I'll show you how to get there in a second, but just realize that the default is going to undeposited funds. The other place that it could be going to is the checking account. Those are your two major places where you would be recording these items. Now, that will depend on whether or not you need to do further grouping. Once again, if you have those checks that you're just depositing individual checks that are going to be on your bank statement at one at a time, then you may not need this added step. It doesn't hurt to go through undeposited funds and then record the deposit, but it doesn't really add anything. It only adds to your process if you're receiving payments that you're going to have to group together and then put into the bank in a format different than the individual receipts of payments that you're receiving. So if you got to receive a payment from John Smith, and then you had another customer, and then somehow you're grouping those payments together because you received, for example, cash, or your Visa credit card company is grouping them together, then you want to go through the undeposited funds so that you can deposit them in the same format that they'll be on the bank statement so that you can easily do the bank reconciliation process. So let's look at the settings real quick so you can see this option down here. You go to the Edit dropdown, Preferences, and then you're going to go to the Payments. So if you go to Payments and then Company Preferences, this thing is usually defaulted as on. So if I had that checked off and I said OK, QuickBooks close all open, it's going to close the open windows. So I'm going to say, okay, you have change. I'm not going to save that change. And hopefully I didn't mess anything up. I'm going to open this back up. I'm going to go to Home Page. And then I'm going to go to the Receive Payments again. And then if I go back to the prior Receive Payment, then you'll see that thing is gone now. So that's the default. Why would you want it gone? If it's gone, notice that nobody could go in here and kind of, if your process is to go to undeposited funds, then you don't really want to give someone the option of changing that to, say, the checking account, which they might do. They're going to say, hey, I received a payment. Shouldn't this go to the checking account? And they might change it. So you might just remove this and remove the temptation to make any change from that and just drive everything through the undeposited funds. However, if you want some things to go through the checking account, then you'd have to go to the Edit dropdown, Preferences, Payments, Company Preferences, and uncheck that. And again, if you have not unchecked that, then it will be checked by the default. So you have to check that off. It's going to close all the windows again. Company, Home Page, Maximize, and Receive Payment, and then back to the prior item. So then you have your option here. So if I select the drop down, then I could go to the checking account. If I went to the checking account, it would change it. What would the transaction be? The fact that it's a customer payment or receive payment form or simply payment form means that we're decreasing the accounts receivable. The other side is going to be going to either some type of cash account, either undeposited funds or typically the checking account, depending on your settings here. Now you might be saying, well, why would it always be decreasing the the accounts receivable? What if I got money what if I got paid? I got money for work that was done today at this point in time. If I close this back out, that would be the create the sales receipt. So this form would be the form that you would use if your example would be like someone walks up to the cash register and pays you at the same point in time they buy the guitar. This form then is reserved for those types of receipts that you would have for invoices that were sent in the past, and therefore this form is always going to be decreasing the accounts receivable unless it's recording like a deposit that was made before the sale. That's a strange situation, so we'll talk about that more in a future presentation, but just note that's something that could be the case. Okay, so let's look at the forms up top. We're going to go to the Reports dropdown, company and financial, take a look at the balance sheet standard. Balance sheet standard, changing the dates up top in the customized reports from 01/01/21 to 12/31/21. And we will say OK. And then in undeposited funds then is down here. So that's the default that is increasing when we have our payment form. It's a form of cash, really. And you might be saying, well, why isn't it up top, like next to the checking account? It's not next to the checking account because for QuickBooks, the checking account form type, or that type of account, has its own kind of features related to it. So because it's a cash type of account, there's different kind of things you can do to it. And so they don't, you could, from a functionality standpoint, the undeposited funds, although it's technically cash, because you're talking about having cash on hand, it doesn't function as a checking account type of account, and therefore it functions as an other current asset account, and therefore it's down here in other current assets, even though basically it's a cash account. Now, this is the item that oftentimes people have problems with. If you have money represented here in undeposited funds, then it should be, you should have physical cash, like in your hands or in the check register, or in the check register, in the cash register, or have checks on hand, right? If you don't have checks on hand and whatnot, or cash on hand, and there's something in this account, then something went wrong somewhere along the way, and you're gonna have to figure out where that went wrong along the way. If I go into the undeposited funds, this is just like a clearing account, right? It's just gonna be going up when you get the payment before you've gone to the bank and actually deposited it, just so you can group the deposits. So this account will be going up then with payment forms, and notice now they say payment forms. So we've seen 3 ways that this thing looks like. I mean, if I go to the home tab, they're called create sales receipt. And if I go into the transaction detail, they're called payment. That's the account type. So the payment means sales receipt. And then if I double click on them, they're called customer payment form. So those are all the same form. So just make sure that you're picking up the proper form there. So I'm going to or that you know all the names for it. So I'm going to close this back out because it's useful, because if you see that in the type field here, you know that payment form means that it's a receipt from a customer, and therefore the other side's going to be decreasing the accounts receivable. So the undeposited funds will be increasing by the payments. That represents money that we received on account for an invoice in the past, or the sales receipts. That's the one that represents us making a sale like at the check register and getting payment at the same point in time the sale was made. And then they're going to go down when we make the deposit, representing us taking it out of our physical hands, or grouping it whatever way we are and putting it into the actual checking account. So that's what the deposit is. It's going to go into the actual checking account. So if we were to kind of tick and tie these out, we should be able to basically go through here and tick and tie them out. They're going to go up and then they're going to go back down, right? We're going to have the same kind of transactions. And at the end of the day, this should go basically back down to 0. It should go up and then basically back down to 0 here at certain points. So I'm going to be closing this back out. So that's going to be our flow on the undeposited funds back to the balance sheet here. The other side of that is going to be in the accounts receivable. So if I go into the accounts receivable, we're looking for the payments. Now the accounts receivable is just going to have 2 kind of things that happen. It goes up with the invoice, us invoicing or billing the clients, and then it's going to go down with the payments when we receive them. Payments mean that we're getting paid on account. We're getting paid for invoices that went out in the past, unless it was a deposit, which is that weird situation we'll talk about later. So there we have the payments in here. And then closing this back out, also note that when we receive payments on account, then we also have the subsidiary ledger related to the accounts receivable that will be tracking that information. So if I go to the reports drop down and go to the customers and receivables and look at the customer balance detail report, changing this from 01/01/21 to 12/31/21, then we have the same kind of payment information broken out by customer in our subsidiary report. And the bottom line of the subsidiary report, 13,872, needs to match the balance sheet here, the 13,872. So notice also, if we go back to the home page, that once we receive the payment, of course, the next step is to record the deposit, meaning we're actually going to record it in the checking account in our books, and we want to do it in the same kind of grouping that it's going to be on the bank statement so that we can do the reconciliation properly. This number 2 represents that there are items in undeposited funds that were created from either the received payments or the create sales receipt. When you click on undeposited funds, those 2 items then will show up in this little pop-up window, which you can check one by one. And then in so doing, you can group the deposits properly so that they will show up in your checking account in the format of the grouped format rather than one by one individually. So closing this out, notice when you receive the payment, then you might get a check in the mail. Just simply open this up and then record the receipt of the payment. Or you could go to the customer center up top. And you might then search by your customers over here and see what open invoices are there for the customers, for example, and then look for the payment. Or you might go to the transactions over here and look for the invoices that are open. So if I was to say I want to look at the invoices that were open invoices, and double click on one of them, you say, all right, there's the invoice that I want to tie out to. So then you can go, I want to have a receive payment up top, and then link it to the payment. Again, I think most people would get the payment first, right? They would probably get the payment, then type in this case, Anderson Guitars, and that's when the invoices would link down below to it. But you could do it the other way. You could, I'm going to close this back out. You could search by the open invoices here, and then link the payment to the invoice, so you can find the invoices that are open either in the open invoices, or you can find the open invoices by particular customers and then go from the invoice to the payment. Some people might feel more comfortable doing that.